Hello. Today I'm going to talk about quantitative risk management at insurance firms. Uh, Usually we talk about QRM in banks and asset management firms, and less in insurance firms. But QRM is also hugely important in the field of insurance. Right, the nature of the business in insurance is very unique. A lot of activities are very uncertain, and you need to therefore account for the uncertainties in the future and be ready for it. And therefore risk management is extremely important, and quantitative risk management is very, very important. That means use of mathematics, use of models, use of data, use of algorithms. In fact, in the field of financial services, I would argue that the insurance field is perhaps the first to use mathematical models for various purposes, whether it's risk management, for whether it's the pricing, and a host of other things. And later banks and other type of financial service companies started using quantitative models for various activities, but insurance is the first one to use. And the business of insurance is about risk transfer, right, from one party to the other. If you want to insure yourself, right, your family, your health, you buy an insurance, right, and you pay a premium, right. How much premium to pay, right? How to do the calculation, at what age you should pay, at what premium, right? That depends on a number of things, right? And that calculation is very mathematical in nature. How does the insurance company make sure that it has enough money to make the payout in case of, let's say, the insurance company has to pay to the person who died prematurely, and he has taken a term insurance, right? Or somebody who is hospitalized and they taken health insurance, or somebody who had a fire insurance and there was a fire in the house, and the property was lost, was burnt. How does the insurance company pay? How much money it should ensure that it gets as the premium, to ensure that in such instances it has enough money to pay? So the lot of things which are very mathematical in nature. That means you cannot simply do these things through qualitative decision making process. So you have to make use of data models, and so on. All right, so it's very data driven. Okay, so and the goal here is to identify the risks, the different types of risk in the future. In the world of insurance, what's important is that the market risk, the fluctuation in the asset prices must be accounted for, right? Because the insurance companies, what they do is that they take the money from you, the premium, and they put that money in different investment products, right? So ensuring that the money grows, but at the same time ensuring that there is enough liquidity available when it comes to when there is a need to make the payment to the customers, right? Then capital allocation is very important. Where to put the capital, right? uh, and then ensuring that you're meeting all the regulatory requirements, right? Nowadays regulatory reporting is very quantitative in nature. You have to do forecasting in the future and provide details to the regulators, and for that there's a need of data models and algorithms. And just to do the internal steering, you also need data models. So for a variety of reasons you need the quantitative risk management department within an insurance firm, right? And what is QRM, right? If you're new to QRM, if you have never heard of it, well, it's about the use of models, use of data to to quantify risks in your portfolio. um, and well, risk management is obviously an integral part of any financial service company, but not all financial service companies use quantitative techniques. There are not so sophisticated or mathematical techniques available which you can use in order to do risk management, but that's less sophisticated. I wouldn't imagine any modern company doing those techniques anymore. In the modern world, every single risk management department is becoming very quantitative, right? So use of statistical or actuarial models, right, for a variety of purposes. And in the world of insurance, what's important is that to ensure that you predict the cash flows, right? There will be um, premature liquidation. There could be also cases of just discontinuity of the insurance product by many, and some people might move to different other companies, right? So cash flows are very uncertain. Reserves, whatever money the insurance company has to be properly allocated to different investment products. That allocation, how best to allocate the money, considering the requirements in the future, considering the profits to be made and all that, and the fees and transaction cost and everything, that's you know mathematical, and therefore models must be used. It's very mathematical actually, as I've said, right? Unlike in banking, where if you learn a bit of statistics, you can get started with risk management. Insurance is different. You have to learn financial mathematics very well. You have to learn probability very well. You have to learn Monte Carlo simulation, Markov chain. So understanding of probability and distribution is extremely important, right? People who write actuarial certification, they learn quite a bit of probability in the course. In fact, it's one of the most difficult paper in the actual certification. You have to understand the market risk matrices, for example, the value at risk, and how to calculate value at risk for a given portfolio, conditional value at risk, and various types of value at risk. Understanding of copula, understanding of different forms of correlation, asset correlation, and so on, very important. Monte Carlo simulation goes without saying, is extremely important. Understanding of stress testing, scenario testing is very important. So these are some of the tools and techniques one should learn if you want to work in QRM in various insurance companies. Beyond that, there are also requirements from the regulators. You have the SCR requirements, the solvency capital requirements, like you have, for instance, in the banking world. You have the Basel II and Basel III accord, making compulsory for banks to do reporting on various aspects. You also have similar requirements for insurance companies, right? Either companies could use standard formula provided by the regulator. There can be global regulator, but also local regulator, right? So there's something to take into account. That means you have regulatory requirements which are very similar to other across all jurisdictions, but there can be also jurisdiction specific requirements. But regardless, the requirements are can be very quantitative, and either you use standard formula given by the regulators to do the calculation for capital, for all kinds of reporting requirements, or you use internal models, right? So apart from pricing and other kinds of internal purposes, non-regulatory purposes, you also have to use mathematical models for, let's say, capital reporting. Okay, so it's both. It's also in the same in banking, right? You have models used just for capital reporting, but you also have models used for other kinds of activities. For example, early warning indicator, and for credit scoring and all that, right, in the banking world. Okay, a lot of the models are also used for underwriting purpose, by the way, in the insurance world. Stress testing is extremely important. Like in banking, it's very important that what could be the potential scenarios in the future. What would be the capital requirement in those scenarios? Will the insurance company have enough capital to make the payout in such stress scenarios if that happens, right? There can be several such scenarios. There could be in natural, climatic related. There can be scenarios related to war, macroeconomic issues, so on and so forth, right? Or pandemic and so on, right? So stress testing is extremely important and also quite mathematical in nature. And the QRM department is responsible to perform stress testing activities in insurance firm. There's also use of advanced analytics, the more modern techniques such as the ML AI in the world of insurance is more recent, but people have been experimenting for the last 10-15 years use of predictive analytics using ML type models, tree based models, or even the more recent AI models, including Gen AI. People are using now Gen AI for varieties of underwriting activities. I've heard from many people working in insurance, right? Also for monitoring, real time monitoring, which used to be very manual in nature, but now it's more model driven. There is use of machine learning there. Okay. And MRM, which is the model risk management. In the world of banking, this is very popular, right? You have dedicated model risk management departments in most banks and NBFCs. But you also have model risk departments in insurance firms as well. And they do pretty similar kind of work, right? Which is to assess whether the models used for a variety of things, whether it's for pricing, for risk assessment, for capital reporting, for stress testing, whether these models are fit for use or not, whether they are free of error or not. Are there assumptions which do not hold in the real world? So these are checks that the model risk department does on the models used for varieties of purposes, right? So whether it's about validation, backtesting, governance, and independent review. So you have a model validation department which is independent within the insurance company that performs reviews, independent reviews on all the models in production, right? All right, so these are some of the things that the MRM department does, and it's if you're working in the MRM department in a bank, you can easily move to an insurance company. Just learn a bit of insurance products, a bit of regulation, but the actual technical work would be more or less the same. Some of the emerging trend that you could see in the world of insurance, now you see climate risk is given a lot of importance, I think for good reason. Also in the banking world, right, you see a lot of emphasis given to climate risk and sustainability, and regulators are pushing the insurance companies to account for climate and sustainability in their modeling activities, whether it's pricing of assets, whether it's predicting risk in the future, pricing of different products, for example, collateral valuation, so on and so forth. Use of advanced analytical tools, for example, the big data or IoT tools for variety of data collection. So it's about the alternate data. Apart from the traditional data that you have in tabulated form, insurance companies are also encouraged to collect data from satellite, from IoT devices, and so on and so forth, right? So it's a very interesting area, by the way. Use of modern technology such as cloud computing and making everything real time and not just making everything real time. That means the insurance managers simply can press a button on their cell phone and get to know what is the potential risk they see in the next 1 month in the portfolio they are managing, right? They don't have to ask an analyst to prepare a report for that. They can simply do that themselves. So that kind of activities are currently happening. Many people are developing solutions for that. So this is something I see as the next big thing happening in, I think, in all kinds of areas in the financial service industry, where things will be more real time. Tech will play a big role, data driven, and a lot of analytical work will happen. And if you are someone looking for jobs in the field of analytics, in insurance, or in financial services in general, I think this is one of the finest time to be. and just make sure that you learn the right stuff, and yeah, prepare yourself well. If you want to learn more about advanced analytics used in the field of insurance, if you want to learn how data science, quantitative modeling is done in the field of finance, insurance, asset management, and trading, and so on, I do have a course on quantitative finance. If you want to do that course, let me know. You can find the details in the description section, but also in the comment. Reach out to me. I'll help you out starting a career in the field of financial services as a risk modeler, or a quant researcher, or a quant developer, okay, or even a data scientist in these fields, right? Someone who is interested in mathematics, someone who is interested in statistics, and you have the interest to work in the financial service industry. There are a host of roles. Let me know. You can reach out to me. Thanks, guys.